Welcome, University of Sydney. I will start time as soon as a member of your team begins speaking. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Insurance Australia Group is a leader amongst Australia and New Zealand's general insurers, historically generating the highest profitability ratios. However, IAG is facing a perfect storm of headwinds, which will prompt it to lose its shine, warranting a sell recommendation with a 12-month target of $4.32, a 12% discount to the 1-month VWAP. Over the last 5 years, IAG has divested its international brands to refocus on Australia and New Zealand, and also reduced its struggling commercial portfolio to refocus on its core segments of motor and home insurance under a range of brands. However, IAG's customer growth has begun to flatline as the company grows complacent, and we believe IAG's limited geographic and product diversification will be its downfall for future growth. IAG is particularly weakened in an industry that is faced with the dual effects of rising costs and reduced pricing momentum in a downturn. Generally, insurers will pass on the costs of extreme climate losses by raising their premiums. However, with the Reserve Bank of Australia affirming in February that wages growth will remain stuck below 2% for the next 3 years, household insurance spending will continue to fall. And IAG's premium pricing makes it disproportionately exposed to customers switching to other brands. In the year to date, IAG's share price has fallen further than its competitors, affirming our sell thesis. However, it continues to trade at a 24% premium on a forward price-to-book versus ROE basis, and we believe IAG has further to fall. Therefore, we issue a sell recommendation with a target of $4.32 and a 12% downside, based on 3 key drivers. First, IAG is expected to lose market share in its core products, as well as face rising reinsurance costs, which will cause IAG's margins to converge with the industry. Finally, with the devastating impact of lower for longer yields, IAG no longer deserves its historical premium.
IAG's struggling commercial portfolio has forced it to refocus on its personal lines, which includes home and motor insurance. However, IAG's personal lines will not deliver the desired 3% top-line growth due to aggressive competition and IAG's premium price point in an economic downturn. Within the commercial space, IAG is over-indexed to SME clients and thus hit hardest by the SME exits and downscaling following the rollback of fiscal stimulus and IAG's premium deferral program. IAG will be forced to exit the SME lines ahead of the plan remediation currently priced in by the market and effectively restrict them to their personal lines. However, within personal lines, IAG's motor insurance will suffer from a knock-on effect for aggressive competition in the compulsory third-party insurance market, also known as greenslip. With 50% of greenslip customers bundling with motor insurance, IAG's 6% greenslip market share losses will have a severe flow-on impact on IAG's motor volumes as customers bundle with cheaper competitors. Further, IAG faces intense margin pressure in home insurance, where their leading market share makes them overexposed to a forecasted 21% contraction in dwellings approvals. Rising costs, driven by heightened climate risk, is also set to outstrip policy premiums, placing downward pressure on margins. Aggravating these factors, IAG also faces higher switching rates as growth in their digital channels expose customers to online aggregators, making it easier to compare prices and policy coverage. IAG's 20% premium price point renders them unattractive to increasingly price-sensitive customers who are set to cut insurance spending by up to 12% in the ensuing low-wage growth environment. With its customer base shrinking and IAG unable to execute their traditional strategy of raising prices to mitigate volume losses, we anticipate a price-volume trade-off leading to a 200 basis point GWP compression in the FY21 results.
Exacerbating issues with its top-line growth, IAG is set to experience rising cost pressures from both its claim and underwriting expense, brewing the perfect storm for margin compression. The threat of climate risk comes as no surprise, with this being years in the making, and IAG has historically remained unscathed. Leveraging its premium pricing momentum of 5% year-on-year increases across its portfolio, IAG has historically passed on cost inflation to its customers, preserving its superior operating ratio. This, however, has come at the cost of becoming increasingly reliant on reinsurance coverage. Premium expense as a percentage of GWP stood at 15% in FY15, increasing to nearly 40% by FY20, significantly higher than its competitors. With impending quota share renewals, management themselves have acknowledged the prospects of higher reinsurance costs in their first half update. And all this while, markets have been blinded to IAG's poor ability to accurately estimate its natural peril budget, blowing out its allowance 11 times in the last 14 years, and the worst is yet to come. Being most exposed to a hardening reinsurance market that has been experiencing low return on equity from years of high payout, IAG's aggregate catastrophe cover is already shrinking, putting downward pressures on IAG's loss ratio to realign to industry average levels of 70%. Additionally, with the optimization program at an end, we see that markets have significantly over-anticipated the scope for further cost reduction in its underwriting activities, offering no saving grace for a company in the midst of a tough insurance cycle. With IAG stuck between a rock and a hard place, it will lose its fight to preserve margins, and its price on book premiums will no longer be warranted.
Beyond underwriting, IAG's investment income will continue to face its own challenges amidst an effective lower bound environment, expected to push realised yields to unprecedented lows. IAG's underwriting profitability has historically allowed income earned on policyholders' funds, the funds backing their insurance liabilities, to flow directly to the bottom line. But this income stream is expected to fall almost 50% from FY20 levels, failing to recover in line with underwriting profits. Following 115 basis points of rate cuts since the start of FY20, Australia's cash rate now rests at the effective lower bound, where Reserve Bank commentary indicates it's expected to remain until at least FY24. While markets are far from blind to this fact, the impact of lower for longer rates is yet to be unmasked, with capital gains on held instruments so far more than offsetting lost yields. However, this unsustainable trade-off will soon unravel, as the lower bound leaves no room for further instrument appreciation. For IAG, this lost yield will begin to materialise immediately, with $425 million of annual yield deficit expected by FY24, as 75% of owned instruments mature in an effective lower bound environment. Turning now to shareholders' funds, those in excess of the expected claims but required for regulatory purposes, this low yield narrative is echoed. A recent reallocation in response to market volatility leaves 80% of the fund trapped in fixed income. And, contrary to market opinion, we see it staying this way. A re-risking is just hard to justify when equity is costing you 7% to earn a potential 6% on high-yield corporate credit or a highly uncertain equity return, especially where these attract an 8 or 16% risk charge from the regulator. This is further unsupported by a contracted credit fan, undermining any strategy of simply moving across investment-grade spreads. All in, we expect shareholder fund returns to fall 30% from FY20 levels.
We valued IAG using a residual income model, dividend discount model, price on book versus ROE regression, and equity multiples to imply a target price of $4.32, a 12% discount to the 1-month VWAP. Acknowledging the continually uncertain macroeconomic environment, we sensitized our valuation to key drivers, including GWP growth, reinsurance and claims expenses, and fixed interest yield. However, withstanding these optimistic assumptions, our bull scenario generates a limited 5% upside. Risks to our sell thesis include investors likely regaining confidence in future underwriting profit growth if IAG were to persist with price increases whilst preserving retention rates. However, we see increasing customer churn during the current downturn, as challengers take advantage of the flight to value in insurance policies, minimizing this risk impact on our margin forecasts. Outside of market risks, significant ESG headwinds exist for new CEO Nick Hawkins. In the aftermath of its Swan Insurance debacle, IAG has strengthened its social pillar through premium deferral and forbearance programs. However, IAG is a lone mover in this space, with both Suncorp and QBE withdrawing from increasingly risky rural books. As IAG attempts to convince the market of its nil exposure to greenfield credit policies, we see its prior mistakes on pandemic contract wording casting doubt on underlying governance. In sum, IAG has lost its shine and no longer deserves its historical premium. A restriction to low-growth segments and geographies will prevent market share growth. Rising cost pressures will compress margins beyond consensus forecasts. And lower for longer interest rates are a red flag for IAG's investment saver. For IAG, the underwriting is on the wall. We are from the University of Sydney. Thank you for listening, and we now open the floor to any questions.
Thank you. Judges, at this time, please turn on your video. As a reminder, stay muted unless you are speaking. I will start time as soon as a judge asks the first question. Time will end at 10 minutes. Feel free to begin.
I'll just start with my question. Thank you for your presentation. I just wanted to highlight the fact that most investors invest up to 80% of their portfolios in fixed income instruments. So can you please elaborate on the fixed income investments held by the company, please?
Yes, certainly. So firstly, talking to that 80% number, while I certainly agree that a lot of insurers hold a similar quantum of fixed income, for IAG, this is a marked increase on what they've historically held, and that can be seen on the graph on the left. They historically held a much higher concentration of equities. Turning to what exactly makes up those interest-bearing investments, as we can see on the right-hand side, it is heavily concentrated in AAA and AA rated instruments, as well as government and semi-government bonds and corporate bonds and notes. And within those, they also flag material concentrations to the Australian financial sector, to the big four banks.
Okay, congratulations for your presentation. My question implies something that we have seen in the Australian market regarding the elevated catastrophe claims that we recently saw. And with that, it came some price rate increases that have sustained in time. And I want you to ask if these new levels of prime rates, of premium rates, could imply a margin expansion that you are not fully considering.
Yeah, certainly. I'll take that question. So if we move to slide 38, yeah, I agree that there has been increased catastrophe risk, especially in Australia, given the catastrophic bushfires and floods. However, we don't think that will lead to margin expansion. First, because the high level of risk actually means that the policy premiums go up to account for that risk. So the policies are priced to actually capture the risk rather than make more money from the high levels of risk. And secondly, from that, we believe that the heightened level of catastrophe actually makes a lot of premiums quite unaffordable for most customers. So, for example, home insurance premiums have gone up by 150%, and actually by in around 50 to 80 years' time, around 10% of Australian homes will actually be uninsurable because no one can actually pay. So I think going forward, that will play into the long-term forecast for IAG and also their long-term growth rate.
So perhaps I could quickly follow up with the cost perspective with the increased risk from these bushfire-related incidents. So while premiums may increase, we also do see a secondary impact, for example, with its reinsurance expense. So if we flick through to slide 43, we know that currently speaking, IAG's loss ratio is comparatively speaking to its competitors at an advantage, but we really do see this to be realigning in the foreseeable future just because of a hardening reinsurance market where reinsurers themselves are demanding higher premiums for their coverage, both in terms of its catastrophe-related types of coverage as well as its quota share arrangement. So with this secondary impact coming from reinsurance, we see that margins will not be increasing in the foreseeable future.
Thank you, everyone. Oh, go ahead.
Quick question for me. This is Simon.
Appreciate your thoughtfulness in terms of the valuation aspect and the consideration of the various valuation method. Can you share with us a little bit more in terms of the allocation to each of your valuation method and the motivation behind this allocation?
Absolutely. Thank you for your question. As we can see at the slide in front of you, so at a high level, we've included a fundamental valuation of 50% and a relative valuation of 50%. And the reason for that is we want to isolate IAG specific risk and growth profiles, whilst also recognizing that the Australian insurance sector is quite small with only 3 major players. So if I can take you first to the fundamental methods, our residual income valuation has been weighted 4 times our dividend discount valuation, primarily because dividends for IAG from FY20 to FY22 are quite volatile. And for a 6-year forecast horizon, we don't think those are quite apt to forecast terminally. And then on the relative side, we have equity multiples, which are a price on book and a price on equity. And we see that there are disadvantages to each of those methods. Firstly, on the price to equity side, earnings have been quite skewed by the recent COVID pandemic. And then on the book side as well, we're seeing that our capital perhaps isn't as relevant going forward. So instead, if I can quickly take you to our regression slide on slide 75. So this is our final valuation method. And what we've done here is we've taken the price on book versus ROEs for 20 global property and casualty insurers, which we've handpicked. And each of these 20 insurers are similar to IAG in terms of their risk profile, their growth rates, and the segments that they target. And therefore, we weighted this at 30%, which is the second highest weighting. And combining all those together is how we get a good differentiation between the fundamental values of IAG and then also the broader insurance market globally, which we think is quite important.
All right, thank you. Well, it was a wonderful presentation. My question is on the business cycle side. So you have mentioned several times that growth is declining, kind of a recessionary type of economic downturn type of narrative. I actually trade several, macro assets in Australia. And the consensus economic growth for next year, for 1 year forward in Australia, is 3.8%, with an inflation consensus forecast of 1.9. So, and an unemployment rate of 5.7. So, as you know, we obviously COVID pandemic did create a recessionary environment for most countries around the globe. But there's been so much fiscal and monetary stimulus that practically all economies are recovering strongly from this, barring another COVID, resurgence. So how does that affect your whole analysis? Because the premise is recessionary, which I think is maybe when you started this was the right environment, but is not the current environment as a consensus.
Sure, I'll take that question. If we move to slide 35, we can see that indeed inflation has is forecasted at 1.9%. However, wage growth remains low at 1.25%. And so with inflation outstripping wage growth and also IAG's planned premium increases of 6%, much outstripping wage growth, we do believe that their pricing strategy simply is not sustainable going forward. But even apart from that, following the recent results of the Royal Banking Commission, a lot of consumers are aware that big banks and insurers such as IAG are overcharging for coverage that is simply unnecessary. And so we do see that prompting a lot of consumers to switch to challenger brands that have more transparent pricing and more tailored coverage. Simply none of the unnecessary coverage that IAG has currently.
So just to round that out, you are absolutely correct in that Australia has fared quite well amidst the pandemic. We have very strong GDP growth outlook, but we see wage growth as somewhat disconnected to that, and that in itself is quite pandemic related. Australia has fared well, it has good growth outlooks, and we think that that is going to attract huge levels of immigration and keep wage growth kind of planted around this 1% figure, even though broader GDP growth might be higher.
Thank you.
If there's still some time, a quick question for me this time again. Can you comment on the IAG recent in the early part of the month of March that comments on their zero exposure to Greensill collapse? So they have made a claims that they have zero exposure.
Yes, certainly. I'm happy to take this question. So at a high level, IAG used to own a subsidiary in Australia called BCC, and they wrote trade insurance policies to Greensill. And they subsequently divested that company to Tokyo Main. And as part of that acquisition agreement, they agreed to take the exposure for all those credit-related policies. So once Greensill entered administration, people were turning to what you're seeing on the left, which is an outtake from the Credit Suisse Supply Chain Finance Fund PDS document. And it says that Insurance Australia wrote...
Thank you, University of Sydney. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university is brought in.